Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Thursday, 21st August. Coming up on the show, there are signs that the tech sell-off is easing after days of big losses for some of the nation's biggest stocks. Investor focus now shifts to Jackson Hole. They'll be looking for any clues of what the interest rate path will look like. And in the last few moments, Walmart has just released its latest earnings report. I'll bring you the details. So grab your coffee and let's own the morning. Well, we kick off the things you need to know by looking at the US Futures Board. And they're suggesting that the tech sell-off, initially they were suggesting that the tech sell-off could be easing after a two-day sell-off that's wiped off 2% off the Nasdaq. Just to quickly mention as well that the dollar paired gains after rising to its highest level in 2 weeks and treasuries fell. The Nasdaq there sort of in the flat there. Okay, well that tech sell-off has come about as investors flock to other sectors amid mounting fatigue with big tech over concerns on AI spending. Yesterday, some big tech names continue to come under intense selling pressure. Both Apple and Amazon were down around 2%, as you can see. Google parent Alphabet down around 1%. And even one of the biggest beneficiaries of the AI boom, Palantir, it was also down around 1%. But consumer staples, healthcare and utility stocks all climbed at the same time as investors rotated into so-called value sectors at the expense of these sexier tech names. Okay, the recent declines in big tech names comes amid warnings that the hype surrounding AI could be overdone. Moving on to the next thing you need to know about, and in the last few minutes we've just heard from Walmart. The market was looking for revenue to clock in at just a smidge over $176 billion. In fact, what we got was $177.4 billion, so a beat on revenues. But adjusted earnings per share came in at 68 cents. The markets were looking for 74 cents, so a miss here. We'll dive into more of these details later in the show. And finally, the last thing to know about is Jackson Hole. But even before central bankers descend on Wyoming, the Fed is hitting the headlines again, with Fed Governor Lisa Cook saying she will not be bullied into resigning. Remember, President Trump has called on her to step down after one of his allies, Bill Pult, who heads the Federal Housing Finance Agency, urged the Attorney General to investigate Cook over a pair of mortgages. Okay, moving on to Jackson Hole, and Yahoo Finance will be keeping across every story that's coming out of this crucial meeting. Our very own Jennifer Schonberger is on the ground there.
Good morning, Ramzan. Central bankers from all over the world are flocking to Jackson Hole today ahead of Fed Chair Jay Powell's big speech on Friday, where investors will be looking for any signals for a rate cut come September. The White House is pressuring the Fed to cut rates, while the markets are pricing in a 25 basis point rate cut for next month. But the Fed is facing a dilemma right now for both sides of its dual mandate. On the one hand, they're dealing with a weaker job market. On the other hand, inflation perked up in the month of July. So the question is, will Fed Chair Jay Powell strike a moderately restrictive tone again, saying that the Fed needs to wait and see on account of higher inflation data for the month of July? Or will he be swayed by the latest jobs report, which showed a weaker payroll number? Powell had said during his press conference following the policy meeting after the July FOMC meeting that he saw downside risks to the job market, and that was before the July jobs report. This will be Fed Chair Jay Powell's last speech as Fed Chair here in Jackson Hole, where he is likely to mark his legacy. We will also hear any proposed changes on the Fed's monetary policy framework, where the central bank is likely to drop its average inflation targeting. Chair Powell's speech slated for 10 a.m. on Friday here in Jackson Hole. Back to you.
Okay, that was Jennifer Schonberger from Jackson Hole. Okay, for market movers, we're going to focus on the big box retailers. Now that we've heard from the three biggest this week, Walmart, Home Depot and Target. Well, let's recap what we heard from Walmart, the world's largest retailer, just a few moments ago, and see how its shares are doing in the pre-market. And as you can see, shares are down around 1% in the pre-market. Now, as I said earlier, revenues beat on expectations, but earnings per share missed at 68 cents. The market was expecting 74 cents. The shares price, though, ticking closer to the flat line there, though. Now, Walmart, it actually raised its full-year sales guidance, and it has and gave sort of an optimistic signal about what they thought, how the consumer's feeling about purchasing. And that's despite rising concerns over inflation and possibly some weaker economic data that we've seen recently as well. In fact, over the year, shares are up over 13% for Walmart. The S&P as a whole is just up 9%. But since Liberation Day back in April, the stock is up over 25%, as you can see there. Now, the retailer has paid a lot of attention to its low price strategy in order to offset any uncertainty that's come about as a result of tariffs, and also as households have become more cautious when it comes to their budgets. Okay, let's move on to Home Depot. Now, earlier in the week, it kept its annual forecast intact despite posting muted quarterly results on Tuesday. Both revenue and earnings per share just missed the mark. On results day, its shares actually gained 3%, as you can see there, but have pared back some of those gains since. But the retailer did say that some products may see small price hikes due to tariffs, after previously suggesting they would generally not change. The top US home improvement chain is betting that customers will continue to spend on smaller scale maintenance projects, and that demand from professional contractors will stay strong in the second half of the year. Less clear is when the stalled US housing market and major home renovations that require financing will start to pick up. Now, Home Depot, which sources more than 50% of its products from the US, said there would be modest price hikes in some imported goods that currently face higher tariff rates than what it had anticipated back in May, when the company said it would generally maintain pricing, but that some items could disappear from shelves. Finally, let's move on to Target, and the story here wasn't really about their poor results, but the change at the top. Its shares fell over 6% yesterday after the company also named Michael Fidelki as its next CEO. Now, Fidelki was the retailer's CFO, so no change, he's an internal hire. Okay, the results weren't as shockingly bad as the first quarter, but the retailer is still struggling to find its place in the new economic norm of more discerning shoppers. Now, Target's second quarter earnings narrowly surpassed consensus forecasts as it wrung out cost savings. The company also maintained its full year outlook it slashed 3 months ago, but headwinds from a pressured US consumer, an influx of tariffs from the Trump administration, market share loss to rival Walmart, and operational challenges are clearly quite apparent. Okay, coming up, all eyes on Jackson Hole and what investors need to know about the Federal Reserve's annual gathering. That's next on Morning Brief, Market Sunrise. Welcome back to Morning Brief, Market Sunrise. Now, the Federal Reserve's Jackson Hole Economic Symposium officially kicks off today, with Fed Chair Jerome Powell expected to speak tomorrow. Yahoo Finance's Jared Blikre breaks down everything investors need to know about the conference in today's Stocks in Translation.
It's late August in Jackson Hole, Wyoming, where a media frenzy converges around top finance and economic officials. A fly fishing invitation in the early 1980s turned into the world's most watched macro meetup. What Fed Chair Jay Powell says here can set the tone for U.S. economic policy into year end. That's right, we're talking about the Fed's Jackson Hole Symposium on today's Stocks in Translation. First, what is it? It's the Kansas City Fed's invitation-only economic policy get-together. Each August, central bankers, academics, financial ministers, and select investors gather to debate economic policy. There's no formal vote, just signals. The symposium got its start in 1978 as a regional Fed gathering. By 1982, the Kansas City Fed, they moved it to Wyoming in Jackson Hole to lure the chair of the Fed, Paul Volcker, an avid fly fisherman, and he showed up. The rest is market folklore. And after the global financial crisis, these August remarks became a thing that investors watch and sometimes trade. So let's highlight now what Jackson Hole is and what it is not. It's a policy symposium, a gathering to discuss big economic trends and ideas. It's speeches, papers, and debates. But don't call it a Fed meeting. There are only 8 official FOMC meetings each year, and Jackson Hole is not one of them. There's no formal action, no vote, no interest rate decision, and no economic projections. But the Jackson Hole Symposium isn't just Fed officials, it's central bankers, finance ministers, and top economists. They're comparing notes, stress testing ideas, and sometimes they tip the next chapter of policy. The guest list is very small, but the echo is global. The conversation here sets the tone for the months ahead, and after the summer ends and everyone gets back to business, well, that's when the policy making starts. Taking stock of some of the more notable years, we had to begin with that 1982 meeting that snagged the interest of Fed Chair Paul Volcker. That set an important precedent, but the meeting would not be closely watched by investors for decades. You're going to notice the next year on the list is 2010. With the global financial crisis still fresh in everyone's minds, Chair Ben Bernanke teased options for so-called QE2, lighting up the possibilities for a huge new round of monetary stimulus. Stocks rallied and investors paid attention. And just a few years later, Mario Draghi, head of the European Central Bank in 2014, flagged weak inflation expectations. This set up a big central bank pivot in Europe, once again providing important market signals. Fast forward again to the pandemic year of 2020, and Chair Powell outlined a brand new policy, target inflation. It had been in the works for years, and it was an important shift in Fed policy. Now, here's what investors are going to be listening for this year. The Fed has two mandates from Congress to consider: maximum employment, meaning a solid job market, and stable prices, which means the Fed needs to pay close attention to inflation. So, if Powell sounds optimistic about employment, that it's tight, or that wages are still growing at a firm pace, well, then that signals he's less inclined to cut rates to stimulate. That's what's called hawkish. And on the other hand, if Paul talks about the job market cooling or that wage growth is losing a bit of steam, that suggests that more rate cuts are on the horizon, which is called dovish. And when it comes to inflation, any words like sticky or stalled progress signal hawkishness, and talk of a broader cooling of prices or any disinflation, that's dovish. This might be an oversimplification, but you get the picture. Bottom line, it's a small room that can provide big signals, and what officials say there can set and reset fall policy expectations across rates, stocks, and the dollar. Not every year is seismic, but the chance of a giant reveal keeps investors tuned in, and the media coverage adds to the frenzy. Tune in to Stocks in Translation, the podcast, for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Coming up, we'll take a look at some of today's trending tickers and give you the news behind the moves. That's next on Morning Brief, Market Sunrise. Welcome back to Market Sunrise, and now it's time for today's trending tickers. We're watching Johnson & Johnson, WH Smith and Disney. First up, Johnson & Johnson. It's announced plans to expand its manufacturing in the US. The drug maker is building a new facility in North Carolina as part of a $2 billion commitment to Fujifilm's new biopharmaceutical site over the next 10 years. The project is expected to create more than 100 new jobs in the state. The company says it will share plans for additional manufacturing facilities in the US in the coming months. Now, this comes as the pharmaceutical industry braces for potential drug import duties. Now, next up, it's British retailer WH Smith, and it's seen its shares nosedive this morning after an apparent accounting error saw a major overstatement in its profits in North America. The share price has dropped over 40% in the pre-market, and at the time, in the market at the moment, and it has led to slash its full-year profit forecast drastically from £55 million to just £25 million. The UK headquartered group has around 1,300 stores worldwide, including the travel stores in America, in Motion, and mainly they're based in train stations, hospitals and airports under various other brand names. Now, WH Smith has said in a statement that the error has been blamed on an accelerated recognition of supplier income. Okay, finally, Disney's new ESPN streaming service officially launches today. It lets subscribers access the full range of ESPN's programming outside of a cable bundle. This is the biggest shift in Disney's transition away from legacy networks to digital distribution. The service costs about $30 per month, and it will stream more than 47,000 live events each year. Well, that does it for Trending Tickers. You can track the best and worst performing stocks with Yahoo Finance's Trending Tickers page. Okay, the Trump administration is considering taking a 10% stake in Intel in exchange for some of its CHIPS Act funding, and that could be just the beginning. Officials are reportedly eyeing stakes in other chip makers that have received funds, including Micron, Taiwan Semiconductor, and Samsung. That's according to reports from Reuters. Yahoo Finance's Julie Hyman spoke to a panel of experts about the White House's relationship with corporations. Take a listen.
Bob, I want to start with you. When we look at the landscape of the companies that have taken CHIPS Act funding, who should we be zeroing in on now as now potentially having some kind of partnership with the government?
Well, obviously, I think you would probably look at the U.S.-based ones because I think it's going to be pretty hard to convince TSMC and other companies from outside the U.S. for some of these deals. It's going to be Micron, there's Global Foundries, there's TI to some degree, although they got a much smaller amount. So, I think that's probably where it ends up. But look, the bigger issue that we have to be talking about is this really the right thing? The government has given subsidies to farmers and to all kinds of other industries, and there's never discussions of payback and investment there from an earnings perspective. And I think it raises some very serious questions that we need to be thinking about because there's potential long-term implications here that I don't think are very good.
On that front, I was struck by a column from Greg Ip in the Wall Street Journal that was out about 10 days ago, even before this latest round of talk about Intel. And he wrote, a generation ago, conventional wisdom held that as China liberalized, its economy would come to resemble America's. Instead, capitalism in America is starting to look like China. And Gautam, I want to bring you in on that. Companies don't seem to be raising a big ruckus here because those that have gotten, sanctioned in various ways, right? So how do you think this will work between the government and Intel or whoever else?
Yeah, companies are objecting because they're afraid. It's really just that simple. And CEOs of major corporations think of themselves as some of the most powerful people in the world, and in many ways they are. But if you compare even the most powerful CEO of the biggest company in the world to the president of the United States, you're comparing a pygmy to an elephant. There's just not even a competition. And so this is a president who's demonstrated over and over again that he's willing to use the powers of the federal government, even illegally use the powers of the federal government, to punish people who he doesn't like and who disagrees with or, on a whim. And CEOs individually are all saying, look, I can't play that game. Collectively, they might be able to stand up to him, but strikingly, the organisms of collective action, the Chamber of Commerce, the conference board, things like that, are just not standing up and acting as organizers to get CEOs to rally together and use their strength collectively. Well,
it seems like in part, Gautam, it's because maybe they're getting some benefits from this as well, right? In the case of Intel, yes, it got that $2 billion infusion from SoftBank, but if it does strike this deal with the government, is it more of an advantage than a disadvantage?
Intel clearly has had some troubles over the last few years, but I don't think they're so desperate for cash that they need this $10 billion from the government when what you're doing is essentially letting Howard Lutnick and Donald Trump into your boardroom and allowing them to dictate the future course of the strategy for your company. They're making claims about they're going to be non-voting shares, but nobody believes this, right? It's completely implausible. And so even apart from the national level issues where the federal government is not capable of administering this, doesn't have these abilities, none of these things make sense. From an individual level, being the temporarily fostered patron of the Trump administration might be good for a week or two, but I think Lip Bhutan knows better than anybody, right? That a few weeks ago, Trump was calling for him to be fired. Now he's the favorite child. Next week it could be something else, and no company can be run like that.
Okay, we're going to stick with the tech theme because we've got a developing story coming out of the Magnificent Seven lineup and its AI dealings. Meta has decided to pause hiring in its artificial intelligence division. The company has made headlines over the last few months after making several major hirings from direct rivals in big money poachings. But they've now decided to slow their expansion, suggesting it was related to basic organisational planning. However, it could be linked to growing concerns that investment in AI has been moving at too fast a rate in a week where the selling off of US tech stocks has accelerated, as we've mentioned. Now, according to a Wall Street Journal report, Meta has divided the AI arm of the company into 4 groups, with the overarching unit still being referred to as Superintelligence Labs. It comes as somewhat as a surprise, with OpenAI CEO Sam Altman revealing earlier in the year that Meta had offered some of his staff, get this, over $100 million in signing on bonuses. Superintelligence Labs is part of Mark Zuckerberg's vision of creating an artificial intelligence that surpasses human intelligence. But now there are concerns that the artificial intelligence boom may be experiencing a sudden disruption, with Sam Altman adding that he believed much of the furore and spending on AI was indeed a bubble. However, some analysts have dismissed this notion, pointing out that Meta is more likely to be in self-assessment mode after such a huge spending outlay. Engineers and other talent will have to be on the same wavelength before they can make any breakthroughs. Interestingly, short sellers this week potentially made billions betting against some of the biggest AI stocks as the uncertainty persisted around the stock market and the comparisons being drawn to that dot-com bubble back in the 2000s. All right, before we go, let's have a look at where the markets are. Let's start with Asia, and it's a bit of a mixed picture here. Both the Nikkei and the Hang Seng falling there. There seems to be an air of caution surrounding investors in the region before that Jackson Hole meeting. They're very keen to hear what Jerome Powell will have to say tomorrow. Moving on to the European markets now. After a 3-day winning streak, markets there are firmly in the red. As you can see, there's been some pretty disappointing corporate earnings in the region today. I mentioned WH Smith earlier, but also the ticket giant CTS Eventum. It's falling sharply after releasing results. Its revenues were actually better than expected, but still the markets didn't like what they heard. And that's weighed down there on European markets and general sentiment there. Now, there's a big story breaking from the European banking sector that's worth keeping an eye on. Mediobanca investors have rejected a Banca Generali bid in a blow to CEO Alberto Nagal as he attempts to secure the bank's independence. All right, let's have a quick look at US futures. And, well, they were close to the flat line earlier, and they are still pretty flat. They are in the red. Remember, we've had a big sell-off in tech as traders have stayed guarded ahead of the Federal Reserve's gathering in Jackson Hole, which is obviously going to be the main focus. And this week's seen pressure on tech stocks, particularly the largest names, amid worries that their sharp rally since April advanced too quickly. Okay, and let's have a quick look at Walmart if we can. Shares there are down in the pre-market still, I believe. Yes, down almost 2.5%. Okay, that's it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. I'm Ramzan Karmali. Go own the morning.